Every single day, somewhere in this world, two countries that have nothing to do with America are buying and selling from each other. Maybe it's a Japanese company buying oil from Saudi Arabia. Maybe it's a Brazilian firm paying a Vietnamese supplier. And here's the part that should make you stop for a second. They're not paying in yen. They're not paying in reals. They're not paying in reais. They're paying in US dollars, a currency issued by a country that isn't involved in the transaction, printed by a government that didn't earn it, controlled by a central bank that neither party elected. How does that happen? How does one country's paper become the entire world's money? And more importantly, what does it cost everyone else? To understand this, you have to go back to a hotel in New Hampshire in the summer of 1944. The war isn't over yet, but the Allies can see the end coming. And the people who run money, the economists, the treasury officials, the architects of the post-war order, they know that whoever controlled the financial system after this war will control the peace. So 44 nations send delegates to a resort called Bretton Woods. And over 3 weeks, in a series of rooms that smelled like cigarettes and ambition, they redesigned the global economy. Here's the deal they struck. Every country's currency would be pegged to the US dollar, and the US dollar would be pegged to gold at exactly $35 per ounce. It sounds almost quaint now, but at the time, it was logical. The United States held 2/3 of the world's gold reserves. Their economy hadn't been bombed into rubble. Their factories were intact. They were the only nation that could credibly back a global currency. So everyone accepted it. And just like that, the dollar became the world's reserve currency. The anchor, the reference point, the thing everything else was measured against. Now here's where it gets interesting. For about 25 years, the system worked. Global trade expanded, economies rebuilt, the dollar held its value. But then something quietly started to break. The United States was spending money it didn't have. The Vietnam War, the Great Society programs, rising domestic spending, and as the US printed more dollars to pay for all of it, other countries started to notice something uncomfortable. They were holding American dollars. But America didn't seem to have enough gold to back all of them. France noticed first. President Charles de Gaulle, who had a flair for the dramatic, actually sent a battleship to New York Harbor in 1965 loaded with dollars, demanding gold in return. He was calling America's bluff. And America was, in fact, bluffing. By 1971, President Nixon had seen enough. On a Sunday night in August, he went on television and told the world that the United States was ending the convertibility of dollars to gold. Just like that. No international vote, no multilateral agreement, one country, one speech, one night. The gold standard was gone. Here's what most people miss about what happened next. You'd think that destroying the foundation of your currency's credibility would be catastrophic, that the world would abandon the dollar, that another currency would rise to replace it. None of that happened. Instead, the dollar got stronger. And the reason is one of the most audacious deals in the history of money. It's called the petrodollar system. And it starts with a plane ride to Saudi Arabia in 1974. Secretary of State Henry Kissinger flies to Riyadh. He meets with King Faisal, and the arrangement they reach, never formally published, never officially confirmed, goes something like this. Saudi Arabia will price its oil exclusively in US dollars. OPEC, the oil cartel, will follow. In exchange, the United States will provide military protection and security guarantees to the Gulf states. Think about what this means. Oil is the most important commodity on earth. Every country needs it, every economy runs on it, and now To buy oil, you need dollars, which means every country on earth needs to hold dollars, which means there's always demand for dollars, which means America can print them and the world will absorb them. The gold backing was gone, but the oil backing replaced it, not officially, not by treaty, just by the quiet logic of necessity. This is where the math starts to feel uncomfortable. When a country needs dollars, and they all do, they typically buy US Treasury bonds to hold their reserves. That's how most central banks park their dollar holdings, which means the entire world is effectively lending money to the United States government at relatively low interest rates, which means America gets to borrow cheaply, which means it can run deficits that would destroy any other country's currency. This concept has a name. It was coined by a French economist in the 1960s who was already annoyed about it back then. He called it the exorbitant privilege. America gets to consume more than it produces, import more than it exports, borrow more than it should be able to sustain, and the rest of the world finances it not because they want to, but because the system leaves them very few alternatives. Now let's zoom out, because by this point you might be thinking, okay, America won. America built a clever system. What's the problem? The problem is stability. A reserve currency isn't just a financial instrument, it's a responsibility. When you are the world's money, your domestic decisions become everyone else's problem. When the U.S. Federal Reserve raises interest rate, which it does to control American inflation, it causes capital to flood back into dollar assets from everywhere else. Emerging market currencies collapse. Debt crises break out in countries that borrowed in dollars. Commodity prices crash. Countries that had nothing to do with American inflation policy suddenly find themselves in economic freefall. This happened in 1982. It happened in 1997. It happened in 2022. The Federal Reserve Chairman sits in Washington and makes a decision about the American economy. And somewhere in Argentina, or Turkey, or Nigeria, an ordinary person watches their savings lose half their value overnight. They didn't vote for that chairman. They had no input into that decision, but they live with the consequences, and here's the irony that runs through all of this. The countries most harmed by dollar dominance are also the ones most dependent on it. They can't just opt out. Their trade is priced in dollars. Their debt is denominated in dollars. Their central banks hold dollars as reserves. To leave the dollar system, you would have to rebuild your entire financial infrastructure. Find new trading partners willing to accept your currency. Convince commodity markets to reprice in something else. It's the financial equivalent of trying to leave a city where every road, every airport, every shipping port was built by someone else. And they get to charge you a toll every time you use them. So what happens now? Because this question is no longer theoretical. China has been building alternative payment rails for over a decade. The yuan's share of global trade finance has been growing. Russia, after sanctions cut it off from the dollar system in 2022, dramatically accelerated its de-dollarization efforts. The BRICS nations, Brazil, Russia, India, China, South Africa, and now several others, have openly discussed creating an alternative reserve currency. In 2023, Saudi Arabia, for the first time, publicly acknowledged it was open to settling oil trades in currencies other than dollars. That's the sound of the petrodollar arrangement creaking. And yet, the dollar still accounts for roughly 58% of global foreign exchange reserves. The next closest is the euro at around 20%. Every serious alternative has a fatal flaw. The euro lacks a unified bond market to absorb reserve flows. The yuan isn't freely convertible. Beijing controls it too tightly to trust it at scale. Gold is awkward and slow. Crypto remains too volatile and too small. The dollar is dominant not just because America is powerful, but because replacing it requires solving a coordination problem that nobody has figured out how to solve. You need a currency that everyone agrees to use. And the only way to get everyone to agree is if everyone already uses it. Here's the thought I want to leave you with. The US dollar didn't take over the world because it was the best option. It took over because of a war, a resort in New Hampshire, a Sunday night television address, and a plane ride to Riyadh. It was built on gold. Then the gold was removed. It was rebuilt on oil. Now the oil consensus is fraying. What it runs on today is something harder to see and harder to replace. It runs on inertia, on the absence of a better alternative, on the fact that the world built its financial plumbing around one currency, and nobody wants to pay the cost of replacing the pipes. That might be the most durable foundation in economics, or it might be the most fragile. Because systems held together by the logic of there's nothing better have a strange habit of staying stable right up until the moment they don't. And when they go, they tend to go fast. The question isn't whether the dollar's dominance will end. Every reserve currency in history has eventually ended. The pound sterling, the Dutch guilder, the Spanish real. The question is what the world looks like in the transition, and whether anyone will have seen it coming.